You might know that an IPO is the only way a company raises capital by offering its shares to the general public. But there is one more way through which a company can raise capital. Want to know about it? If yes, this video is for you. And make sure that you stick around until the end.
Hello guys, this is Shweta and welcome to the world of WallStreetMojo.
What is direct listing? Companies having IPOs need to go through lots of procedures and compliances. For example, they need to abide by security laws and exchange rules. And they also have to deal with investment banks, underwriters, and many others. But the company can bypass all this and offer its shares to the public directly, and they can do it through a direct listing. As the name suggests, in the direct listing, a company would straight away list their shares on the stock market and offer the general public and investors to purchase their shares. The direct listing method of raising capital is beneficial for small to medium-sized businesses that already have some reputation among the people. Direct listing may not be common, but some really good companies have raised capital from the public this way. In 2019, Slack completed a direct listing on the New York Stock Exchange. The stock had opened at $38.50 from the reference price of $26. In 2018, Spotify, the streaming giant, used the direct listing strategy to raise capital. The stock had opened at $165.90 from the reference price of $132. There are several other examples of companies that choose the direct listing method. Such companies set outstanding examples demonstrating that companies can raise capital without going through the traditional IPO route. Benefits of direct listing. The primary benefit of the direct listing method is that companies can bypass mediators like banks, underwriters, private equity firms, etc., and can directly offer their shares to the public. This also allows them to avoid paying various costs associated with IPOs and fundraising. But the company might have to appoint an investment bank as a financial advisor to handle the regulatory filing, price discovery, securities law compliances, and investor communication before the direct listing happens. The company can set the price and period of the offering, minimum investment, total shares that investors can buy, and the settlement date. Another benefit of the direct listing is that companies don't have to undersell their shares, which they would have had to do in an IPO. Lastly, the company doesn't have to create new shares and can list the existing shares in the direct listing. Even existing shareholders and employees with ESOPs can list their shares. Both methods of raising capital are becoming popular as startups are raising at an unprecedented pace. But this gives rise to a debate on direct listing versus IPO. And here is a side-by-side comparison of the two. We have consolidated the comparison briefly in the table below. Take a while to go through it. Pause the video if you want. As you can see from the table, the objective of both is to raise capital. The difference may lie in how the companies raise capital, that is, by offering existing shares or by creating new shares and offering those to general public. We already saw that in the direct listing there is no intermediary, while in an IPO there are a couple of intermediaries present. The absence of any lock-in period in the direct listing is one more advantage. With affordability, a direct listing makes it cost-effective for companies to raise capital, while an IPO might cost them a lot. Moving on to the availability of shares in a direct listing. The availability of shares depends on the employees and investors. In contrast, in an IPO, the shares may be readily available as the company creates new shares for the listing. The buying process is a standout difference between both modes of capital raising. You might know that in an IPO, you can book or subscribe to the shares for yourself that would be allotted or given to you later on. But in a direct listing, you can buy the shares only after the company has listed them on the stock exchange. Finally, the direct listing might result in more liquidity and volatility for the shareholders, while an IPO may have less liquidity and volatility. So this was all about direct listing and its comparison with IPOs. We hope you have learned a lot from this video, and if you think you did, show it to us by liking it and sharing it with others. Don't forget to subscribe to the channel.